It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And Heidi Ho, it's the mayor of the great state of Texas real estate, Mr. Michael Becker. Michael, how are you?
Hey, Paul, still trying to come down from the high of the Old Capital Conference. I thought it was pretty great this year.
Yeah, we had almost 600 investors come to the Arlington, Texas Live Performance Hall. We had a comedian, we had vendors that would be like bankers, and we had title company attorneys, we'd have real estate attorneys, we had SEC attorneys, we had guys that put Humpty Dumpty back together again in multifamily. So what a success. And those deals just don't happen by itself. It happens with everybody that is all part of the success, and starts with James Eng and his wife, Christine. The professor goes out of his way every year to put on a better and better event. And so we certainly do appreciate James and Christine doing a knockout job for all the investors in Texas. And so I know that we had you up on stage leading the charge, and some great questions that had come out. And we had a question that came in, Michael, I thought was a pretty good one, because it's kind of a check where the market is right now. Because we have a lot of people that are they're fairly new to multifamily. They've heard rumors, the great demise of multifamily in the last, say, 3 to 6 months. But I don't think that's the way. I think people are going to be shocked to hear the amount of business that's still going on. And the question that came out is, Michael, how is the market these days, and should we be investing in multifamily?
Yeah, Paul, like I said, I think obviously there's been some headwinds, which we talked about. The fundamentals are still pretty darn strong, and the Sunbelt multifamily and Texas, to be specific. Those that read the quarterly newsletter I put on, I kind of went through some stats here in the most recent third quarter newsletter that we put out. And, I'm actually doing a deal right now, Paul, in Austin. And so I kind of have some real time. We're kind of right in the middle of it. So about a week into it as we record this podcast today. So still probably have another couple weeks as this thing gets released before we're, fully complete with all the paperwork. So kind of can go through some real time, some experiences. Would make sense, Paul?
Yeah, I think it would, because a lot of people just don't understand it. So let's start at the beginning. How did you find the deal, and where's it located at, and why do you like it?
Yeah, so the deal's located in Hutto, which is a suburb of Austin. So it's kind of like the northern corridor of Austin, maybe 25 minutes or so outside of downtown Austin. And it was a fully marketed deal that went out in April, and the broker kind of went out at a number. I'll try to conceal it a little bit here on the podcast. So if anyone does want to find out more information about this too, before I get too deep into it, and you're not into our investor database, I certainly encourage everyone to go to our website, which is spiadvisor.com. That's www.spiadvisor.com. There's a form to fill out, a contact us form, and we can send you information about this if you're interested in learning a little bit more about this, or getting our newsletter or whatever going forward. So that out of the way, found the deal, went to market in April, and they kind of woefully underperformed. And so they were about 5 or 6% below the guidance, got awarded in May. And that group kind of had it tied up in escrow for 30 to 40 days. They ultimately got to the end of the diligence period. They couldn't get their equity lined up, so they dropped it. And then we got a 5-6% discount to that price. So we're about 12% off the initial whisper, and about 6-7% off of where it was awarded. We got awarded the deal in late July, and so now we're just kind of in the process of putting it together. So it was a marketed deal, Paul. The debt market, as we talked about on some of the previous episodes, got a little choppy, and so the pricing's kind of fell to what we thought was a pretty attractive level, and so we were able to kind of step up and get awarded the deal at that lower basis.
Tell me a little bit about that area. I mean, a lot of people that are not from Texas have no idea where Hutto is. In fact, I had to look it up on the map to see where it was, but it's in the northeast section of Austin. But what is that area? What's going on in that area that is just blowing up? Maybe it's the second Silicon Valley over that way?
Yeah, what so whether it's this deal or any kind of other deals we're looking at, some of the things that we look for, Paul, are really high growth corridors. And there's a lot of them in the major Texas markets that we participate in. And so those of you not familiar with Austin, it's got 3 major highways To the west is Mopac. To the center is I-35, which goes from Canada to Mexico, right down the middle of the country. And then to the east is the newest highway. It's about maybe 10 years old, called Highway 130. And this is just located right off this brand new highway. It's, maybe 10 years old. And those that aren't familiar with Austin, to the west, you got a lot more topography. To the east is a little bit more flat. So there's a lot of growth kind of on the eastern corridor. So it's right off a major thoroughfare, which is, something that we like. You have easy ingress, egress access and across town. It's also pretty close to two major east-west kind of thoroughfares. It sandwiches two of them. So you got pretty good connectivity. And then there's been a lot of economic growth up there, Paul. It's really close to the Dell corporate campus. It's maybe 7-8 minutes from the Dell headquarters, just a little bit east of that. And then recently in November last year, Samsung announced a $17 billion chip manufacturing facility for semiconductor chips going to go in Taylor, Texas. And those of you who aren't familiar, Taylor, Texas is a tiny little town about 15 minutes northeast of my property with, pretty limited population and infrastructure. So this is a pretty close proximity off of a major thoroughfare to this major plant. And subsequent to us getting awarded the deal, they announced that they're talking about having further expansion of that plan over the next several decades of upwards of $190 billion. So what I like about this project or any project that we do, and this is a good example of it, is you're in a location that has some major growth drivers, not just for the immediate term, but in this case, kind of intermediate and longer term. Once you put that type of capital into a location, these companies just don't walk away from it. It's very supportive of job growth and population growth for, decades to come. So that's some of the reasons why I really liked it. Plus having good accessibility to, retail and better school districts. Those are the things that really drew me to this location.
Again, how many units is the property and how old is the property?
It's a brand new construction deal, 336 unit deal over in the Hutto submarket. So it's, that's another thing I like about it is, high quality construction. Everyone keeps hearing about the supply chain issues, which appear to be kind of, easing themselves up kind of as we speak. They're kind of working through the system, but, we don't have necessarily the capital risk of a deal like this as you would to an older value add deal where, what used to cost you $3,000-$4,000 to renovate now costs you $8,000 or $10,000 to do a very similar renovation from, 5 or 7 years ago to today. We don't have that because everything's brand new. And, the deal's actually finishing its initial lease up. When we got awarded it was in the kind of the 50+% physical occupancy. It's now in the mid to high 70s occupancy and is, pushing 90% lease. So by the time we close, it'll be over 90%. And that was another good thing that was available for us with this opportunity is we're able to go in the Fannie Mae near stable program. So basically that's only available.
What is that? What is that? I mean,
yeah. So a lot of people are probably familiar with Fannie and Freddie kind of agency underwriting. And, when you go buy a stabilized building, they basically look at kind of historical income numbers, kind of your trailing collection numbers. They then go and kind of make some adjustments on their underwritten expenses, like adjusting your taxes up or your payroll up or down, kind of depending on how they you get them to buy off on your pro forma. And then they kind of circle underwritten NOI, and that's what they size off of. And they typically want a 125 debt coverage ratio. So that's kind of the basics of how they underwrite a Fannie Mae traditional loan. Well, with the near stable program, his property was just in its initial lease up. So what was good for us is they underwrote off of, stabilized income over underwritten expenses. So they're going to underwrite this as if it's stabilized with pro forma expenses. So then they kind of circle a NOI number that is a pro forma number. So, in a traditional deal, if the collections drop or the collections go up, it could swing your loan proceed sizing. Where with this program, your proceeds are essentially more locked in just by circling NOI. And then with the type of loan we're doing, the sizing rate was set at application. So then our sizing rate they size off of is also set. So with the treasury moving up or treasury moving down, doesn't really have any impact upon our loan proceeds. So this deal underwrote so well that we were able to get 65% of the purchase price. And we actually just got the loan commitment in today as we record this. So that's going to be what we after that's what's going to be what we're going to close at. So that's great. And this project having a lot of affordability, as well as us being a select sponsor, we're able to get pretty tight spread. So our loan spread is right at 219 over SOFR. So that's 2.19%, which, Paul, I mean, you look at a lot of these other deals, what's kind of a prevailing spread rate today? That should certainly be inside of prevailing rates today.
A lot higher than that. So talk a little bit more about that select sponsor, because people have heard about it, but how did you earn that battle medal?
Years of doing transactions and paying my mortgages on time, I guess, Paul. So it's just they look at like kind of the totality of your relationship with the agencies, and you're doing a lot of deals, and you kind of get the most favored nation status. So they'll give certain waivers or preferential pricing to the more seasoned and repeat borrowers, versus if you come off the street and you're new, you tend to not get as many waivers, and you kind of pay full freight on your spread.
All right, you can say you're not everything's fair when it comes to multifamily, especially when you have a partner with Michael Becker and the group over at SPI. Some great information on that transaction. So if you want to learn some more, go to spiadvisory.com, spiadvisory.com, and anything more that if people wanted to get more information on that one, Michael, because I have a second question that's come up that I wanted to kind of talk about too.
Yeah, I think, just go to our website. If you guys are interested and you've been, listening to my voice for a while, I want to make sure you see this opportunity you have, and just go to our website, which is, like you said, spiadvisory.com. There's a contact us form, fill that out. We'll make sure we get it over, and certainly appreciate everyone's listenership. And if anyone's interested, certainly appreciate a look at it.
Yeah, and make sure you get their quarterly newsletter. You'll find a lot of great information on there, especially if you're learning about multifamily. It's a great opportunity to crack that open and glean some investment ideas on what Michael and his partner Sean do over at SPI. Michael, the other question that had come up, which I want to frame it towards you, is some of these deals sometimes are difficult to put together, and you just recently had a transaction that you put under contract. So that was an accepted LOI. You put the deal under contract with the sponsor, I believe, and that 30 days, 45 days go by, and that sponsor decides to blow out and not go forward. Tell me a little bit, without naming names and things like that, but what's the shift that you guys have to do?
Yeah, we have had a lot of transactions we sold this year successfully, so feel real good about that. And then we have another one that is set to close in a day or two from the recording of this podcast. So that's going to be, I think, our 5th or 6th deal we sold this year. And then we had another deal that we, picked a buyer in July, and the market's kind of shifted, and they had a, contingency period, due diligence period. And, about 30 days, I think 26, 27 days into it, they came to us, said they're going to back out because their lender retraded them and, increase their spread and reduce their proceeds. And so, so they dropped the deal. So that was kind of a rough day, to be honest with you. First and foremost, you don't panic, right? I mean, this is the first time we've had a deal fall out over the years. We've had one of the tougher deals I owned. I think we had to sell it 3 or 4 times before it finally closed. So, you just kind of stick your head down and you kind of go for it. So the initial thing we did was, it was a fully marketed deal. And then we just go to the backup group, and because we interviewed 4 or 5 groups in July when we ultimately chose this group that we went with that backed out. So there was, another group that was kind of, 2 groups kind of neck and neck. So we kind of go back to those 2 groups, kind of see where they're at. Fortunately for us, is one of these other groups was still there, and they agreed to kind of take it over at the same price. Now they have a contingency period as well, which we negotiated an access agreement. It was 45 days from access is their contingency period. So the clock's already, 7 days of that's already kind of gone as we talk right now. So they signed the access agreement so they can do their inspections. And so, they're going to go through it. So this group's a little different. They're going to be in a PFC structure, so Public Funds Corporation. So what the acronym stands for. So they're going to partner with the housing authority, a local housing authority, and have a percentage of the units be affordable, where they have to at least under, I think it's 80 of AMI, 80% of every median income. They'll have some, restrictions, but the benefit they get is they get to have 100% tax abatement. So don't pay any property taxes. So that works on this deal. I'm going to probably look into that a little bit more myself, because that sounds pretty attractive.
What, when you have something fall out, again, it's a bad day at BlackRock to do that. Now you already had something lined up that you were going to buy. what kind of a conversation is that I can't do this deal because my deal doesn't work? How do you talk to the broker on something?
Yeah.
like
So
that?
unfortunately, we had we have a single partner in this deal, and we were planning on doing an upleg, buying another property for the 1031. And so we had identified a property in the Austin area that was going to be the replacement property for this one. And so luckily, just doing this long enough, I was very, forthright and transparent with that broker and saying, hey, this purchase is, based off of, it's going to be an upleg off the deal we're selling. And it's going to be contingent on this guy, going forward and going hard. And so we were awarded the deal a couple of days before this guy dropped out. So timing was just a little too quick on it. But we were trying to make sure we got home on the 1031. So we're kind of a little bit of the chicken and the egg, which one do you go with first, right? So we felt like we needed to get ahead of it, but I certainly made sure that the broker and the other transaction knew that if this deal fell apart and my buyer wasn't hard and everything seems good, but if the buyer falls apart, then I can't proceed with your deal. And so we basically agreed to it. Then a day or two later, I had to call them and tell him that the thing kind of blew out and I can't buy that deal anymore. So that did have a little bit of a ramification, but he understood, and I was certainly forthright with him. I think that's probably one of the biggest takeaways, whether you're buying something or selling something, is to when you're out there talking in the brokerage community, to be straight up and honest and forthright with what you have to accomplish, especially if you're in an environment that's a little bit choppier. And that's going back to the Hutto deal that we're buying. I mean, they were pushing us on this or pushing us on that. And at the end of the day, it was like, if you want to pivot to us, these are the things I can do. And these are the things that I accomplished. And I had already sized this deal for debt. And this is the type of debt I'm putting on it. And this is how my lender's going to underwrite it. And this is how I have limited risk to my loan proceeds or to my interest rate spread because of X, Y, Z. And this was the narrative I told that broker / seller of that property that got them comfortable versus another group who is a little bit more opaque or isn't quite as transparent with what was going on. So I think if you get, one of the main takeaways from the deal I'm selling or the deal that we're buying was, the buyer that ultimately is buying the second buyer that's buying the deal that we're selling up here that fell apart was very transparent with me with all the steps that they've done and all the work that they put into it and what they still need to accomplish. So, it's certainly not a guarantee nothing's done anymore until the wire goes, but at least it felt like they put a considerable amount of effort and time and energy behind it that, made me comfortable going with them and hoping that they can get it done. And I think the same thing with the seller of the Hutto deal that we're buying. Same thing happened was, I've proven to them relative to the prior group they awarded it to, that we've, got a good reputation. They called on my references. I was able to articulate very effectively all the work that we put into it and, why I feel comfortable with this or with that. And, that kind of got us awarded the deal. So I think that's really just kind of your lessons, whether you're dealing with a seller, whether you're dealing with a broker, or whether you're dealing with your bank, if you need to get something off your banker, whether you're doing a loan right now or you're needing something along the way. Being transparent and thorough with everything, it will go a long way in my experience.
One more carve out the Hutto transaction. Anything more you want to say about that one before we close it out for this Ask Mike Mondays?
No, yep. I don't want to be too preachy here, but yeah, I know I definitely appreciate anyone wants to learn more about this or the newsletter, whatever. Just go to the website again, spiadvisory.com, and fill the contact form out there. You can we'll make sure we shoot it over. Whether this works or doesn't work is especially if you're learning, it's always a good way to kind of see how we put these deals together. How do we underwrite? How do we present the transaction? And if this works, that's great. If not, it's a good education tool, if nothing else.
That's great. So I'm happy that you talk with the little investors of multifamily, the ones that want to learn and want to be like Mike in the future. So great information. So certainly do appreciate that, Michael Becker, Mr. SPI, Governor of the great state of Texas real estate. So again, I'm Paul Peebles. Have a great day.